Hi everyone. Okay, so today what we're going to do is we're going to have a look at marginal costing. All right. Now marginal costing, it can be called cost volume profit analysis, or it can be called sensitivity analysis. Just if you see it in any textbooks or workings, just so you know what we're actually talking about there. All right. So what we do is the following. We're going to take a look at the 2023 paper. Okay. And I'm just going to point out a couple of different things to you as we go through it that will make your life a little bit easier. So get rid of those starting off. So we start off, and normally speaking what happens is they give us this statement of profit starting off, and that's all fine. Okay, we have this statement of profit and we have to make a couple of different changes on it. All right, so typically what we need to do is look at our factory overheads and split them up into the variable part and the fixed part. And then there's usually an adjustment for commission here within your selling expenses. So that's normally what we're thinking of when we come into a marginal costing question. But in recent years, you'll have seen that they've started to give you this little part here. So before you get into the marginal statement, they're asking you to use the high-low method, which we would have used with flexible budgets last week. So they're saying to you to calculate the variable and the fixed element of, say, the factory overheads or production overheads or whatever they might have there, okay? And they're saying to us to use the high-low method. So quick recap on that then. So starting off this question, all right, your first little step on that is to calculate that high-low method. Sorry, to use the high-low method to calculate the variable and this fixed part. So we're taking the highest number of units, the lowest number of units, and then we have the cost associated with each of them. So as we go down through it then, what was the highest number of units? So you're going back to the question and you're saying to yourself, right, 100,000 units, 25,000 units, and the associated cost, 420 and 120. So 100,000 units, the lowest number of units then the 25,000, and then the associated cost. We have our 420,000, and then we had 120,000. So again, just like we did with flexible budgets, get your difference. So 100,000 minus the 25, and then your 420,000 minus the 120. So that's the change. And then to get the variable cost, we take the total change in cost and divide it by the change in units. So when you work that out, you're going to have 300,000 divided by 75,000. So it's coming in there at €4 per unit. Okay, so €4 per unit. So that's the first little part done. Now remember, your total costs are made up of your variable and your fixed costs. So if we know what the total cost is, and we've just worked out what the variable cost is, we are going to end up with our fixed. And that's as difficult as it gets, okay? So what we're going to do here is set up a little table for ourselves, total, variable, and it's going to leave us with our fixed. Now remember the way we set that up. All we do is we come along and we say for 100,000 units, and then for 25,000 units. So the total cost when it was 100,000 units was 420,000. The variable cost per unit, we have just worked it out. It's €4 per unit. So we're saying 4 multiplied by 100,000 units. That's all we're showing there. And we get a total then of 20,000. So that's our fixed cost. But we want to double check it. So we verify it by doing the same for 25,000 units. At 25,000 units, the total cost was 120. The variable cost, 25,000 units, times that €4 per unit. So that's 100,000. And then we can see €20,000. So we know that the fixed is definitely coming in at €20,000. And that's fine. We have it set up. Part 2 of that question then is going to ask us about our break-even point, and it's going to ask us about a margin of safety. But before we do that, we have to set up what's known as our marginal statement. Okay, so this marginal statement is the basis of all of our workings for marginal costing. Whether they start off with a high-low method or whether they give you the breakdown directly, we have to get this marginal statement done. So what we're going to do here is we're going to take our initial profit statement and we're going to split up anything that could possibly be a mixed cost. We're going to split it up into its variable and its fixed elements. So if we were to look at it here, they tell us that the material and direct labour are variable costs. So they are definitely variable. Then they come along and they say to us, apart from a sales commission of 5% of sales, so apart from a sales commission of 5% of sales, the selling and admin are fixed. So a little piece of that selling is going to be variable, okay? The factory overheads, we already know a little piece of that is going to be variable. So then that just leaves us with the fixed part. So we have our fixed part, our admin is completely fixed, and then the selling expenses, part of the selling expense is going to be fixed. Now that's a really, really common mistake that students miss that part. They forget to subtract the commission that they have calculated here when they were told 5%. So let's get that marginal statement put together then. So we start off and we have our sales. Now every time you do this, you're going to do the following. You're going to put in the number of units here, and that's really important, okay? So you're coming along and from your question, it's 80,000 units. So we put that in. So always have it there, 80,000 units. Then we look at our total column and we have a per unit basis. So a euro per unit basis here. And we're just marking it in and we take our total figure and just transfer it. So the total figure from the question is 2.16 million. So we just put that in. To get it on a per unit basis, take the 216 and divide it by 80,000. So we have 27 euro per unit. Then we're going to subtract all our variable costs, so less variable costs. So we're coming along here and our variable costs. So go to your question first and take anything that's definitely variable. So materials and direct labour. Sorry, direct labour. So we can put it straight out into that second column there. So 420 and 376. Then we have our factory overheads. So remember what happened here. Our factory overheads, 4 euro per unit. So 4 multiplied by that 80,000. So just a quick recap on where that's coming from. I'm just going to put those in blue so you know the workings. The 4 euro is coming from up here, that 4 euro per unit. And then the 80,000 is coming from here, the number of units that I'm talking about in this production cycle. So 4 by 80,000. My sales commission then, they told us the sales commission has to be 5% of sales. So you're going to take your sales figure, the 216, and all you're doing is multiplying it by 5% or 0.05. Okay, so that's my 108,000. I total that out. And I get 122,400. When I subtract that from my sales figure, I get what's known as my contribution. So if you want to think of it this way, your contribution is what buying and selling the product actually brings into the business. So it's what this particular product contributes to the overall profit, if you want to think of it that way, okay? Now, we know that it doesn't end there though. We have all these fixed costs that we incur, okay? So an example of this, imagine you're in your classroom and what you do is manufacture desks. That's your production line. You manufacture desks in the classroom, okay? Somebody has to be paid to answer the phones and take the orders, all right? So if you think that person that's working over in the office, they have to be paid. So regardless of the number of units that are ordered and manufactured and sold, they are going to get paid a set amount, okay? So that's an example of a fixed cost, okay? You must rent the warehouse. So whether you produce 10,000 units or 80,000 units, that rent has to be paid. That's a fixed cost, okay? Now we'll talk a little bit later about step fixed costs, what that actually means, because that's a nice little theory question that can come up. But for now, all we want to kind of get into our heads is fixed costs, they do not vary directly with the number of units that are produced and sold. So go back to your question and take the figures that are fixed. So the fixed overheads, an element of the fixed overhead, or of the factory overhead, sorry, not the fixed overhead. So there is an element of that factory overhead that is fixed. So we worked that out and we said it's 20,000 euros. So that goes straight into my column there, 20,000 euro. We also know that the selling expenses are broken into a variable and a fixed element. So I need to take the full selling expense, the 182,750, and subtract the commission that I worked out. So the 108,000. So the 182,750 coming from the question, 182,750, and I need to subtract the 108,000. Again, a really, really common mistake where students leave that out. So what you want to do is train yourself into that now, that you're not going to miss that. So if you are really methodical with how you produce these when you're practicing them, it'll be second nature on the day. Muscle memory alone will have you come along and go selling expenses minus the commission. And then your last part is the admin expense, which you were told was fixed. So they had said to us here that administration expenses are fixed. So the full 152,500. And that goes in. And now you have all your fixed expenses in. So we total that up and we get 247,250. When we subtract the fixed then, we end up with our profit figure. Now, to check that you're right, you check that profit figure, 688,750. That must match the profit figure you were given in the question. If that doesn't come in as the same figure that you had here, then you have a problem straight away. You haven't split some of these mixed expenses properly. So you're going to have to go back, okay? But it's a nice way for you to check that you haven't missed anything, all right? So do not continue if they don't match, all right? You're not going to get the full marks no matter what happens at that stage. So you check that they have matched. Now we need to get a couple of these on a per unit basis. So take your total variable cost, the 1,224,000, and we're going to divide by 80,000. So that comes in there at €15.30. Now I'm going to just double check. Yep, because it's just sometimes with Excel it rounds automatically, so I want to make sure that I'm not missing anything for you there. And then your 27 minus, so we're at 1170 there for our contribution per unit. Okay, so that's my contribution per unit, CPU, and we are going to use that figure quite a bit. We don't bother getting a fixed cost per unit. There's no use for it as such. Now the only other thing that we're going to do is we're always going to take that total variable cost per unit and we're going to split it, okay? And this is really important. We're going to take that figure and we're going to split it into our commission and into our standard variable cost. And that's going to take away loads of heartache for us. It makes everything really simple to do then. So take your total variable cost. And that's coming in at €15.30. So there's an example of what I was saying. Excel just rounds it automatically, okay? So make sure we have that right. So €15.30. Then we have our commission. Now think about how you got the commission. It was 5% of your sales, but we're doing it on a per unit basis. So 5% of 27. That's where that's coming from, okay? So see your figure here, your €27, your selling price per unit. So 5% of that is your commission. So we worked that out. So we're saying 27 times 0.05, so €1.35 for commission. So that means then that our standard variable cost is €13.95. Okay, so now you have everything you need to answer all the questions that go with this. So what I would do is, now don't use your highlighter, okay, because it might stop it from scanning. But what I would do is I would kind of circle these, okay. So I take the following 6 figures and I would circle them on the day to make sure you don't miss them, okay. Now I'll highlight them here because it's easier for you to see, but just remember the highlight can stop it from scanning properly, so don't highlight on the day. So we are going to use that 80,000, so we highlight it. We're going to use the €27, so we highlight it. The standard variable cost, we're going to use that a lot, highlight it, okay? CPU, we're definitely going to use it, highlight it. The fixed costs, highlight them, and then the profit, we're going to highlight that as well, okay? So there's going to be 6 things you're going to highlight every single time that you do a marginal statement, okay? That's really important. Make sure you highlight them, get used to highlighting them, and you'll absolutely fly this question. So, common mistakes, all right? Leaving in the commission in the selling expense. That's going to be a disaster for you because this isn't going to match up with your profit figure then. The other thing that happens is you go and you do all of this hard work, you get everything set up, and you don't use the CPU. You end up using that €15.30. Please, please, please watch that. I think you'll be absolutely fine if you circle those figures on the day, all right? It's not going to take up a load of time. You'll have it done in 2 seconds, okay? So just circle them, or just a little line underneath them with your highlighter. Just don't highlight the full figure because it can stop it from being scanned. So once you have those highlighted, okay, you're ready to start into part 2 of this. So in part 2 and part A within part 2, it asks you for the break-even point, okay? So break-even point, now think about what this actually is. Your break-even point, you are just covering your costs, all right? You're not making a profit and you're not making a loss. You have just covered the costs, all right? So if we look at that, all right, we're saying that every unit we sell brings in €11.70, all right? So we know what my sales figure is going to be. We know what my variable costs are going to be. And we're saying every single time I sell a unit, I'm bringing in €11.70, all right? That's kind of the profit I have made by selling that unit. But I still have to cover these fixed costs of 247,250. So to break even, to just cover those costs, how many units would I need to sell? Okay, so if every unit I sell brings in €11.70, all we're going to do is take the fixed costs and divide them by the CPU. That's your formula, okay? So you take your fixed costs and you divide by the CPU. And in a way, that's the only formula that you actually do need to learn, okay? Sorry, I'm just going to change the font color for all those, all right? So take your fixed costs, your 247,250. Take your CPU, €11.70, and you're coming along and you're just dividing them. So 247,250 divided by €11.70. So you can see there that that's coming in at 21,132.5 units. That's what you would have to produce in order to just cover these fixed costs. So there it is. It hasn't been rounded there, okay? So I'll try and keep an eye on that with Excel because it does round it sometimes. So in maths, obviously, if we looked at that, we would say you don't round up, you leave it as 21132, all right? But when it comes to marginal costing, I need to produce that 0.47 of a unit, okay? Or I won't have covered the costs. So I always round up. So 21133 units, okay? So I must round up because I need to produce, I can't produce 0.4786 of a unit, So I need to produce the full unit in order to cover the costs. So 21133 units. Make sure you have the word units, or you'll lose a mark every single time that's not there. So we need to be careful on that. The next part of this question then asks you for your margin of safety. Okay, so just so you can see that there. It's looking for the margin of safety. Now, margin of safety is the amount that we can afford for our sales to fall by. Okay, so our sales can fall by a certain amount and we are still not making a loss. We are just covering everything. So margin of safety is always the actual sales minus the break-even point sales. So in this case, the actual sales, the units that we had highlighted up here, the 80,000 units. So we're going to take the 80,000 units and we're going to subtract the break-even point, 21133. So 80,000 units, that's what I'm actually selling at the minute, minus 21133 units. So that means in this particular case, my sales could fall by 58,867 units and I would still be okay. Obviously you don't want that to happen, but that's what you're saying. You're saying you have that luxury. You could have them fall by that and you're still doing okay. Now, very unlikely that an ordinary level question is going to ask you to give a sales value on those. If it did, all you would do is multiply by the €27. So you'd say 21133 multiply by 27 and then the 58867 multiply by 27, and that would give you the sales value. Okay, here it's the units, all right, and at Leaving Cert higher level it has always been the units that they're looking for here. Ordinary level, okay, yeah, they do ask for the sales value, so you have to remember to multiply that. So now you have your break-even point, you have your margin of safety, and again these are high mark figures. Okay, so just to show you very quickly, if you were to look at the marking scheme on this, I'm just going to dip down to it for a second, you can see where the marks are coming in, like 16 marks here, all right. And then for defining what your margin of safety is, the reduction in sales that can occur before the break-even point of a business is reached. Okay, so the amount I can afford to fall by. Okay, and I'm still just covering my costs. So flesh out that answer, and then you had to state what it was. Okay, because the question specifically asked you to illustrate. All right, so you can see it here. Reference the figures you've calculated in part 2. So that's really important that we do that all the time. The next part on this question, calculate the number of units that must be sold at €30 per unit in order to provide a profit of 10% of the sales revenue earned from these same units. Okay, so there's a good bit going on there. Calculate the number of units that must be sold at €30 per unit to provide a profit of 10% of the sales revenue earned from these same units. So here's my advice on this. We are always going to follow the exact same format when we do these break-even questions. We are going to write down what our sales figure is. We're going to write down standard variable cost. We're going to have commission, and then we're going to have fixed costs. We'll subtract all of those and we'll end up with a profit figure. This always works, okay? So no matter what they ask us, if they ask us to change the selling price, we can do this. If they ask us to calculate the number of units that must be produced, if they ask us to find out what the selling price is, if they ask us to find out the profit that's generated, this will always work, okay? So we put down our sales figure now. I'm just going to highlight this part in blue because I'm going to show all the workings in here, and then we'll just have our final figures out in this column. So going through it then, so then we'll just call that our total column, so as we have it. We start off at our sales figure. What are we actually looking at here? So go back to your question and check what it's asking. Calculate the number of units that must be sold. So the question is asking you for the units, okay? So that's the first thing I would do. I'd highlight it and I'd say, right, what am I being asked here? And it's absolutely fine to highlight your question paper. That's not going to be scanned, okay? So the number of units, I don't know what they are, so I'm going to let them be U. So in this case, there will be U units, all right? That's what I have to figure out. I come along then and I'm saying, right, what has happened? that must be sold at €30 per unit. There's my new selling price. So €30 per unit. So it's going to be 30 times U, which is 30U. And that's it. Okay? Your standard variable cost has not changed. There is nothing telling you that the standard variable cost has changed. Okay? So I go back up here and I take that figure, that standard variable cost that I worked out. So my standard variable cost was €13.95, and that's what I'm going to use. So I just come back down to here and I'm saying, right, €13.95 multiplied by the number of units. Don't know what the number of units are, so I just let it be U. So 13.95 U. My commission. So they haven't said the commission has changed, so it's still just going to be 5% of my sales. Okay, so the commission is 5% of my sales. So I know 5% of the sales. So that's going to be 30U, because that's my sales figure. Look at it here, 30U times 0.05. 5% of 30U. So I come along and I'm saying 30 multiplied by 0.05. So that gives me 1.5. Don't forget to keep the U attached to it. Fixed costs, unless they tell you if they've changed, they haven't. So I'll go back to my question, and remember it was one of my highlighted figures. There it is, the 247,250. So unchanged. So 247,250 goes in there. I know that I'm going to subtract all those figures and I end up with my profit. Now look at what they said about the profit. My profit figure was to be 10% of the sales revenue earned. 10% of my sales. So I get that written down. 10% of sales. So what is my sales figure? It's 30U multiplied by 0.10. So 10% of 30U. So take your 30, get 10% of it, that's 3, and don't forget the U. So 3U. Sorry, so it's just glitching a little bit here. Okay, so sorry about that. So 10% of 30U. So 30U times 0.1. So there was my 3U. Okay. So everything else is still fine. We're just kind of working our way through it. So now we have to figure out what U is. That's what the question asked us for. So it asked us to come along and calculate the number of units. So we're ready to do that. So we start off and we have 30U minus 13.95U minus 1.5U minus 247,250 is equal to 3U. Just like in algebra, get all the letters to one side. So I will have 30 minus 13.95 minus the 1.5 minus the 3. So that's all U, and it's all equal to, and then that minus 247,250 becomes a plus when it goes across. And then how do we get that on its own? 247,250, and I'm going to divide by 11.55. So 247,250 divided by 11.55. Now, just to make sure this hasn't. So 21406.92641, and then obviously I have to round that up because I need to produce, I can't produce only part of the unit. So 21407 units have to be produced. So that method works for any instruction you're given, whether it's to change the number of units, whether it's to change the commission rate, if it's to change the, say, standard variable cost because there's a €1 increase in packaging, if it changes the fixed costs, if it changes the profit figure, that format will always work. So I'm going to keep going with this question, and then I'll just take parts from some other questions just to show you how this works, okay? Because it will be fine. It's an absolutely fine question. So calculate the selling price the company must charge per unit in 2023 if the sales commission is increased to 6% of sales and the fixed cost increases by 10%. The volume of sales, so that's the number of units, the volume of sales, and the profit earned are to remain the same. So what are they looking for here? The selling price. Okay, so I come back and that's what I have to do. So again, get this down. All right, so this layout is going to be the exact same. I'm just going to copy it down. So part 4 this time. Okay, so I'm just going to wipe out everything there and we're going to start again. So in part 4, what are they asking us? They're asking us to calculate the selling price, okay, that must be charged in 2023 if our sales commission increased to 6%, the fixed cost increased, but the volume of sales and the profit earned are to remain the same. So they are telling us that we are using the same 80,000 units. Now remember, you always refer back to the original marginal statement. All right, always refer back to that. So 80,000 units. Do we know what the selling price is? No. So it's just going to be 80,000 multiplied by S for selling. Okay, so 80,000 S goes in there. The standard variable cost, they said the sales commission is going to change, the fixed costs are going to change, but nothing has happened to that standard variable cost. So that is still €13.95 multiplied by the number of units, which is 80,000. So 13.95 times €80,000. And that's fine. We have it there. Our commission has changed though. They've told us that our commission has to be 6% of sales. So 6% of my sales. So my sales are 80,000 S multiplied by 6%, so multiplied by 0.06. So 80,000 times 0.06, so 4,800. Don't forget to put the S in, okay? Common mistake. Your fixed costs have increased by 10%. So how do you get that increase? Okay. Take your fixed costs as they are. So remember, go right back up to the original statement, 247,250, and multiplied by 1.1 because it's an increase of 10%. And then what's happening with your profit? They've told you that the profit is to remain unchanged. Okay? Profit earned will remain the exact same. So look at what happens here. Go back up. Take your profit figure, 688,750. And that's it. Okay? So now the only unknown that we have is our S value. So we set it up the exact same as we did in the question above. So 80,000 S minus the 116 minus the 4,800 S minus the 271,975, and that's all equal to 688,750. Get all the S values to the left hand side. 80,000 S minus 4,800 S. Everything else over to the right hand side. So 688,750 plus the 1.116 plus the 271,975, and then just tidying it up. So we come along, 80,000 minus the 4800S. Taking my figures here, 688,750 plus 111. And don't worry, I'll double check these figures for you in a second, just because I know I'm moving through it pretty quickly. So 207. And then we take our figure and we divide across by 752. So €27 and 61.6 cents. So because it's money, we can round to 2 decimal places. So if we were to charge €27 and 62 cents, we will get the same profit that we wanted, the 688,750, allowing for an increase in our sales commission and also allowing for fixed costs to be increased. So 27.62, and again a high mark adjustment there. So just to show you the breakdown on the marks there, okay, we come along and we can see calculating the number of units, the 21407. Okay, so the 21407 there, that's coming in at 14 marks. Now, one thing to point out here, you won't see the breakdown of the marks that are given there, but they are. They go back. So it is worth your while laying everything out properly so as they can go back and see what's happening on it. Then if you look here, again using the algebraic method again, 2762, another 14 marks. Okay, so it is quite handy to pick up the marks because you're going to get the breakdown even if something went wrong with a calculation error or something like that. So don't give up, I suppose is what I'm saying to you. What I'm going to do next is I'm going to have a quick look at another question, okay? And if I have time, I'll come back to the restate using marginal and absorption principles, okay? So if we were to look here at the 2017, again, look what they did. They asked you to use the high-low method, but we know that that's becoming something, okay? We know that that's more than likely going to be there where we have to split the factory overhead, and that's fine, we can do that. But let's look at what style of question they asked you then in this one. Calculate the number of units that must be sold at €25 per unit to provide a profit. So the exact same style of question, and then here, calculate the selling price the company must charge per unit if fixed costs increase by 12%, but the volume of sales and profit remain the same. Similar type question, they just gave you one more in the one we've just done, where they increased the commission that was being paid. Okay, but look at this. After conducting market research, the following options have been proposed. Option 1, reduce the selling price by 10% and spend an extra 30,000 on advertising to increase sales volume by 20%. Spend 40,000 on leasing a new packaging machine at fixed cost. This will reduce the variable cost per unit by €2, maintaining sales at current levels. Prepare a marginal costing statement for each option and then write a brief report for the manager. So what I'm going to do for this particular class is I'm going to take this adjustment, okay, because I want you to see what's happening here. So we're going to take this adjustment and I'm actually just going to apply it to the question we're doing, because you'll have a full set of workings anyway. So we can just take this and see how we would apply it. And that's what I would do if I was studying. I'd get one marginal statement done and then just take all the variations that they give you, because not every marginal costing question is going to have all of the adjustments. Okay, so when you go to the trouble of getting the marginal statement done for one particular question, just go then and take those adjustments and see, how could I change that around? What could they ask me here? Okay, so using the marginal statement that we have, we're just going to try these questions now and see how we get on. So after conducting market research, the following options have been proposed. Okay, so we're going to reduce our selling price by 10% and spend an extra 30,000 on advertising to increase sales volume by 20%. All right, so let's just look. So what we would do here. So our same system, we put in our sales, then we put in our standard variable cost, we put in our commission, and then we have our fixed costs, and then we have our profit figure. Okay, so this is the way I would set it up. They're asking you to make a decision. So if we reduce our selling price by 10% and spend an extra 30,000 on advertising to increase sales volume by 20%, okay? Or if we spend on leasing new packaging machine, the fixed cost coming in there, okay? But look at what it asked you for, a marginal costing statement. So I need to put in one other little thing here. I need to show my contribution. If it asks for a marginal costing statement, okay, so if the question asks you for that, then you have to remember you must show the contribution, because you will get marked down if it's not there, okay? So we're going to do this for option 1. So we're coming along and we're saying, right, what would happen here? So contribution, key that goes in. So reduce the selling price by 10% and spend an extra 30,000 on advertising to increase the sales volume by 20%. Now remember, I'm taking a working from the 2017 paper, but we're just applying it to what we have here, okay? Because it just gives you an extra question then, because you can always go then and try the 2017 yourselves based on the method that I'm showing you here. So your sales, we always put our units in first. So they are telling us that they're going to increase the sales volume by 20%. So you take your 80,000 units and you are increasing them by 20%. So it's going to be 80,000 by 1.2. Now I'm just going to put these in blue so you know they're the workings when you're looking back. So 80,000 by 1.2. So get that set up for yourself, 80,000 by 1.2. So you know you have 96,000 units and they want to reduce your selling price by 10%. So go back up here. Your selling price was €27. You're going to reduce that by 10%. So 27 multiplied by 0.9 to get your reduction. So you have 27 times 0.9. So my new selling price there, €24.30. So now I'm going to use my 96,000 and my €24.30. So I'm going to have my total 96,000 by that €24.30. So that's my total sales figure. My standard variable cost, that has not changed, okay? So they're reducing the selling price. They're going to spend an extra 30,000 on advertising. So that's a fixed cost, that 30,000, and it's going to increase our sales volume by 20%. So I'm taking my 96,000 units and I'm multiplying by the standard variable cost. So what you would do is you'd go back up, take the standard variable cost figure that we have here, the €13.95. That hasn't changed. So I'm multiplying that by 13.95, and then that comes back in. So 96,000 times €13.95. So 1,339,200. Your commission then hasn't said that you changed your commission, so it's still just 5% of your sales. So 5% of the 233. So you can see this works for any of the adjustments, whether you're adjusting units or your selling price, or in this case where you have several adjustments where you're increasing the number of units and then you're coming along and you're reducing the selling price. The format works for all of it. So 5% of your sales. So 116, that's going to be your commission. Make sure you subtract at this point to show your contribution. And the reason for that is because the question asked you for a marginal statement. So it has to be done that way. So 876,960, that's your contribution. And then finally your fixed costs. That 30,000 on advertising, that has been spent. So you're going to take your fixed cost figure. So again, go back up to your original. So you're taking the 247,250 and you're adding on that spend on advertising. So 247,250 plus the 30,000. So then you have a new profit figure coming back in there of 599,710. So that's option 1 analysed. Option 2. Okay, so sorry, make sure you can see those figures. Option 2, same layout again. So take everything in terms of layout, okay, and you're going to bring it down here. Now we're still good for time. So your sales, what's happening now? They're telling you to spend €40,000 on leasing a new packaging machine, so that's a fixed cost. This will reduce the variable cost per unit. So the standard variable cost has changed this time, maintaining sales at current levels. Okay, so nothing happening to my selling price. So I am still using 80,000 units. I get that much in. My selling price is still the 27. 80,000 times 27. No change in the selling price. So 80,000 by 27. Standard variable cost. This time it has changed. So reduce the variable cost per unit by €2. So it's going to be 80,000 times, the standard variable cost was $13.95, but that's being dropped by €2 because of our new packaging machine. So we're saying 80,000 times the 11.95. So 956,000. Your commission then, still 5% of sales, hasn't changed. So I take my sales figure and I get 5%. Subtract my two variable costs, and that will give me my contribution. And remember, I had to show that contribution because it said marginal statement. Your fixed costs then have changed. So you had to spend €40,000 on leasing new packaging machine. Okay, so your original fixed cost was 247,250, and they are increased by €40,000. So 287,250, and you subtract it. So in this case, what is the better option for this particular firm? And you'd obviously tell them to go ahead with option number 2. Okay, excuse me. So you're getting a better profit figure coming back in there. Okay, so you maintained the revenue of 216. Your variable cost per unit went down. Your commission stayed at 5%. And your fixed costs, while they increased by more, you were still after generating more with that reduction of 2, and you didn't have to go near the selling price at all. Okay, so that's the way they do it. Okay, so just to recap on that, get your marginal statement. That's the first thing. Okay, you might have to use high-low first, the factory overheads. What do we need to do next? We check that our profit matches the profit given in the question. That's key, okay? Check that that matches, all right? And then highlight the 6 parts to be used, okay? Really important. Makes your life a lot easier in the long run. And then use the format given. So that format again, sales less standard variable cost less commission less the fixed gives you the profit. Now that will work for all of those workings. Remember, when it says a marginal statement though, you must show the contribution. Okay, so they're the key things there. Now, just before we finish up, I just want to make sure that we're okay on graphing the break-even point. Okay, so if a question asks you to graph the following 2 things, your break-even point, okay, or a step fixed cost, then you need to be really, really clear on what has to go into that. So if I was you, I would have some sort of a little flashcard for myself where I'm saying this is how I approach this. So I'm just going to draw a really rough sketch here for you. It's in the notes anyway, but just to show you how we would go about doing this if it came up on the day. So say you're in there and the question says to you, right, they want you to illustrate a step fixed cost. We'll go with that one first, okay? So we have an x-axis, okay, and a y-axis. Now, on that x-axis, you are always going to have the quantity that you're producing, okay? Quantity, the units, okay? And here you're going to have monetary amounts, okay? So that can be cost, it can be sales, okay? So all we're doing is we're coming along, and if we're illustrating a step fixed cost, okay? So imagine 10,000 units, 20,000 units, 30,000 units. So you hire a warehouse, okay? You're renting a warehouse and it has the capacity to allow you produce 10,000 units, okay? And the cost to hire one of those warehouses, we'll say, is coming in at 12,000 euro. Okay, actually don't need the euro sign there. We're just saying that's what the rent is, okay? So we're working away and we finally get our production up and running and we're able to produce more than 20,000 euro. We have sales for more than 10,000 units, all right? So up until now, when I was producing 10,000 units, this is what my rent cost. It was a standard fixed cost there. The 10,000 units is coming in. Okay, now in an ideal world, you'd love for that to keep going, okay? But what happens is we exceed the 10,000, okay? But the minute you go over the 10,000, you can't produce 10,001 in there. So what happens is you have to rent a second space. Now we're just keeping this really simple. We're saying it's the exact same warehouse in a row of warehouses in an industrial park, and they're saying, yeah, it's another 12 grand. So when we're producing between 10,000 and 20,000, we have to rent 2 warehouses, so it's costing us 24. If I go above that again, it's going to cost, okay? So that's what's known as a step fixed cost, all right? And it's one of these things in the limitations of marginal costing. We assume that fixed costs are straight fixed costs, you know, they don't change within a given period, but the reality is that they are only fixed, say for a certain amount, and then it switches. So typically it is actually a step fixed cost that we deal with as opposed to a fixed cost in reality, in practice. Okay, but that's one of the assumptions that we make for marginal costing, and it is a limitation. Your limitations of marginal costing are the assumptions that you make for marginal costing, okay? And I'll talk a little bit about those in a second. The other one then is when you're asked to graph the break-even point. So again, you're starting off, similar graph, okay? Your y-axis is going to have the monetary value on it. Okay, so we have quantity, or units, on the x-axis, and then we have money on my y-axis. The first thing I'd always get my students to do is graph the fixed cost line. So you put your fixed costs in. So you get those marked in. Now remember, this is done with a ruler, it's not a freehand situation. So fixed costs. Then get the total revenue line done. So what you'll do is you'll look at your question. So say for the question we've just done 80,000 units, and then your sales, so they were 216. And you would graph that. Okay, so you're going to put in your total revenue line then. And again, I would do it in a different color. I would connect that back. If I don't sell any units, my revenue is 0. If I sell 80,000 of them, the revenue goes up to that 216. Okay, so that's my total revenue line in. So TR. The next thing I need to do is put in my total cost line. So your total cost line, what you're going to do is you're going to look at your 80,000 units and you're going to look at your total costs, being your variable cost plus your fixed costs. And you just graph that line. So you will always start here and you'll go out to your total cost. So whatever it was coming in at for 80,000, put in your final point there and then you connect them. So your total cost line is connecting in here. So TC for total cost. And where the total cost line and the total revenue line intersect then, we have our break-even point. You can read it down, you get the units, you can read it across to the y-axis, you'll have the monetary value on it. And then, if you want to show your margin of safety, it's the gap between those two. If you want to get into it a little bit more, you've profit in this particular position and then loss down here. So a nice crossover with business as well, because you have to do them in business, okay? So little things like that. Don't throw away marks that you can easily pick up for something like that, all right? Now, the very last thing that I would say is make sure you are aware of what the limitations are for marginal costing, all right? Now, before I finish up, the easiest way to think about that is think of your marginal statement, all right? We assume that the selling price will always be 27. That's a limitation. So you can actually look at this and go, oh yeah, that's fine. Selling price. Look at your marginal statement. What do I always get? I always get my sales. I have assumed my selling price is the same. Doesn't take into account there's any discounts. Okay. What else do I assume? I assume that my costs can be split easily into variable and fixed. Okay. I don't allow for economies of scale. I don't allow for learning where I get better at making the product, therefore the variable cost per unit drops. Okay. I assume that my fixed costs are constant, where in fact they're actually step fixed costs. So that's the way to do it. Use your question to help you. You know what you're going to have sales, you know you're going to have variable costs, you know you're going to split your variable costs from a mixed cost. So you take, say, the selling expenses, split them into the commission and the fixed element, okay? So there's your split between the variable and the fixed. We assume that can be done easily, okay? We assume that the fixed costs remain constant. All right, so that's what you do in that case. We don't allow for discounts, we don't allow for learning, we don't allow for economies of scale. And that's what you look at, and that's how you answer the theory questions on them. Relate them back to what you have just done. Okay, so that's it for the question today on the marginal costing. Okay, now obviously the material that's going to go up on the platform, make sure you check that as well, because I'll be going through all the other little bits, the tricky little bits, and it'll be broken down into kind of simpler little steps. Okay, cheers guys.